Hey everybody, this is Chris Miles here. Hey, welcome you guys out today. I know that we've got a lot of you joining in right now, and I'm trying to let you all in as you keep popping in here, thanks to Zoom's new restrictions and everything else. So, welcome you out here again. Glad to have Jorge Newberry, who's the founder of American Homeowners Preservation, to join us today. I know some of you, there's different mix of you that are watching this both live as well as those you'll be watching the replay later. Some of you guys are already investing with AHP and you're wondering, all right, is it still a good time to have money here? Is this the safe place to be? Is there more opportunity? What is it? And then others of you that are looking to kind of kick the tires and say, all right, what is American Homeowner Preservation? What is this about? And yeah, is this also a good time? Because right now the market's in crazy, crazy town, right? So glad to have everybody on. Jorge, thank you for joining us today.
Thank you for having me on, Chris. I appreciate it.
You bet. Now, Jorge, like I know I've known you for several years. I know you've been doing this really since really the last decade. You guys have had AHP going and paying people out and things like that. And so, tell us a little bit about you, and then of course, what are you guys doing now with AHP?
Sure. So, AHP started in, like you said, in actually it's over 10 years ago. In 2008, we were originally a nonprofit, which the mission was to keep families at risk of foreclosure in their homes. Over time, we evolved. We found the best way to do that was to actually buy the loans, and then to once you own them and you bought them at a discount, you have a great deal of control over what kind of deals you offer the homeowners. So that turned out to be what gave us some scale. But one of the challenges being the owner of the loan is that the vast majority of states require that you have a servicer actually interact with the borrower. You can't, just because you own a loan, you can't talk to the homeowner and say, hey, we want to make a deal with you. You have to go through a servicer. And what we found was that a lot of servicers, it was a challenge to work with, and especially since we were trying to do things on an expedited basis to do modifications in days, deeds in lieu in days, and servicers just don't work that way. And we were a smaller client, so Bank of America's on the line, and then HP's on the line, and they couldn't change their systems for us. So even though every servicer wanted our business, we went through 9 different servicers over a decade, and we finally determined that none of them, we kept thinking the next one would be better than they were, and they weren't. So in 2017, we decided, hey, the only way to actually do this is to actually become a servicer. And we thought, it's been a lot of work. It's taken much longer than we expected. We're actually, now it's 2020. We started in mid 2017, and we have licenses in every state of the union, plus DC and Puerto Rico, except for New York State. And we had another list of requests from New York State yesterday. It's been active. It's been going on for more than 2 years with them, and we think we're close to the finish line. We hope we are. And that's made us attractive to start attracting larger clients. 2 big things. One is being nationwide and covering the whole country. And then number 2 is we've upgraded our technology. We went from a more modest servicing system to now replacing it with Black Knight technology, which is the same technology that the major servicers in the country that have hundreds of thousands or millions of loans, the same technology that they use. And so that's what we use now. And actually, I should say, we're implementing now. It goes live on Monday. So those ingredients, being nationwide and having Black Knight, has made us attractive to some large funds. So we see a lot of growth over the next few months, especially with what's happening in the country. There's a lot of, all of a sudden, and we'll get to this in my presentation, there's expectations that more homeowners will default as a result of what's going on now than did in the 2008 crisis. So it's really, and a lot of banks and servicers were overloaded then, and we think the same thing is going to happen there, which gives us opportunity to grow our business. And the reality is not only grow our business, but now we can use what we've learned to help more people in doing so. Because when people come to us, we others want to service us to service their loans, partially because we've demonstrated that we can achieve better results than the more traditional servicing platforms.
Great. Well, yeah, definitely look forward to your presentation, like kind of the updates you've got going on here, because I know I've got several questions. Some are mine, some of my clients have passed it on through me that can't be here live. So yeah, like I'd love to see what you guys are about right now, because I know up I mean, up to this point, you guys have been very consistent. You guys have been amazing. And be curious to see kind of how you're pivoting and rolling with the punches here in this kind of new climate, right?
Yeah, it's definitely, I'll tell you, it is, I mean, for a lot of business owners, they've been struggling. I mean, we've had,
Mhm.
it's been bumpy the last 5 or 6 weeks. And we had a team meeting yesterday, and I kind of shared with everybody that, it looks like, we've gotten through what appears to be the worst of it. And we, in terms of just like the work from home, transitioning all that, which was bumpy, and it was bumpy for a lot of companies, and then keeping productivity up and keeping things moving forward. So certainly some things have gotten delayed over the last 5 or 6 weeks, but we are kind of stabilizing and finding a new norm. But there have been some bumps. It's been a very challenging 5 weeks, and as I'm sure for a lot of business owners.
Yeah.
But I think we've navigated okay, and I think I sympathize with a lot of other business owners which are really struggling, and it's for many people it is reacting to a disaster like this, especially on such a widespread scale, it's so unpredictable. You're being hit with stuff that you never anticipated before, and all of a sudden you're reacting to it. I mean, fortunately or unfortunately, I've actually been through kind of similar, almost 20 years ago, it was 16 years ago. And, in terms of my background, at one point I was a very large scale owner of low-income housing across the country, and an ice storm hit my biggest holding and triggered an extraordinary sequence of events in which I lost everything and ended up in $26 million in debt. And that kind of gave rise to AHP. What I learned during that period helped infuse what we do with AHP and how we treat homeowners who were similarly overwhelmed with debt and facing challenges many a times for the first time in their lives. So I see that happening again. And you have to be very flexible and kind of go week by week. You can't make a long-term plan today. You're going week by week. You know what the long-term goals are, and I think that's been helpful. And I keep focus on the team. Hey, we're going to go. We reassess our position every Friday, and that's been really helpful to say this is what we want to get done in the next week.
Mm-hmm. Great.
So let me dive into the presentation. I'm going to start a little bit I'm going to give some background on AHP because, as you mentioned, there's probably some people in your audience who maybe have never heard of AHP much before now, and hopefully we'll tell you a bit about what we do, but then we'll dig into the more recent events and how that's impacting us.
Great.
So let's see. There we go. So a couple of things about AHP that are, I think, still somewhat unusual in the investment and crowdfunding opportunity between the different other crowdfunding and investment opportunities. Number one, anyone can invest. We accept non-accredited investors, which we didn't always. Up until 2016, we could only accept accredited investors. Then we started using Regulation A+, which means anyone can invest. We're open to both accredited and non-accredited investors. The other part that I think is novel about what AHP does is that we have a very low investment minimum. It's $100. Contrast that with 1,000 or 5,000 at many of the other platforms. And we did that because we thought we wanted to make it as accessible as possible to everybody. And in particular, we often try to help low to moderate income homeowners. That's our focus. And we've actually had, some of those homeowners who we've helped, keep them in their homes. They've later on become investors. And I think it's communities helping communities, and that's something we'd like to see more of in all kinds of situations in this country. And we try to do it on a modest scale here. Our investment is uncorrelated to the market, and so as HP, and there's two facets to this. In terms of the servicing business, there's probably more demand for what we do in a down market, and which is why we built it over the last few years, which were clearly an up market, and it became tougher to invest in just buying mortgages at big discounts, which is what we historically did. There just weren't as many mortgages, and when we could find them, the prices weren't as attractive as historically they had been. So it made a lot of sense to pour our resources into building this servicer, and that's what we've done. As we earn money, we distribute money to investors first. Investors get the first 10%. Our compensation, like mine, it's back ended. Whatever after the investors are all paid off, we will, whatever's left, that's ours. So we're trying to look to make that as big as possible. Liquidity, historically with 30 days written notice, AHP will undertake our best efforts to redeem or sell your interest to another investor. So for some investors, this has been the ability to invest and get their money back when they needed it. And it says 30 days written notice. You can actually simply go on the website and say, I need to redeem all or part of my investment. The caveat to that is if you liquidate in the first 6 months of the investment, the returns, and actually, I have to correct this. I apologize. It's actually in the first 12 months, the returns are reduced to 10%, and in the second 12 months, returns are reduced to 11%. I apologize. That's actually from a prior fund, that language. So it actually goes, wow, it goes from, in the first year, the returns are reduced to 8%, in the second year to 9%. I apologize for that.
Right. 10% is the norm, right?
10% is the norm, exactly right. In our prior fund, we paid 12, and then it went to 11 and 10. And overall, it's a social mission. Although we're now a for-profit, we started out as a nonprofit, and the social mission is the same. When we reach a homeowner that wants to stay in their home, we're going to do everything we can to help keep them in their home. And I will say on the liquidity, historically, we've always paid within 30 days. Even some people say, hey, I got to close this deal in a week, and I need the money back faster. And we've been able to accommodate those requests. In the last 60 days, it's become much tougher. We had in the month of March, we had more redemption requests than ever in our history. We had people coming in, hey, I need money to make payroll. I need money. I have a margin call on my stocks. And small business owners struggling with cash flow. So what we do, and it's provided in our documents, that when that happens, we will simply pay out in the order that redemptions were requested. So, it's first come, first served. And
no Wells Fargo paper shuffling, right?
Yeah, exactly. So we have we are currently on target with we're behind we're closer to 60 days right now, but we expect to be, that surge has subsided. It was within two or 3 weeks in March where it just got a lot and it got backed up. So we won't sell assets just to pay investors. We'll pay it from available cash. And so we expect to be caught up with the existing redemptions by the end of May. And there are some that are being processed this week, and there'll be some that are processed next week. So it's an incremental process.
Sure.
So in building out the servicer, there's some positives and there's been some challenges. Biggest thing here has been that we can control the disposition of our assets. We talk directly to the homeowners. If they want to do a mod, we can accommodate a mod. We don't have to ask for tax returns. We can, or any other kind of stuff that isn't always necessary. And we can streamline that process a great deal. For instance, if we get a hold of a homeowner today and they said that they wanted to do a deed in lieu, hey, we've already moved out of the home, we're going to take the $1,000 and just sign over the home, which is what happens. I mean, think about this. Well, when we buy a defaulted loan, there's usually the family wants to stay and they're still in the home, in which case we'll do a modification and it reduces their payments, reduces their principal. And lots of times they're delinquent by 10 or 20,000, and we'll forgive some of that to make it achievable. Maybe they'll give us 2,000 and we'll forgive 10,000 or something like that. And that's all works out well because we bought the loan typically at a significant discount. But if they don't want to stay or the home's already vacant, then we'll try and track them down and offer them cash to sign a deed in lieu. When we do that, we give them, let's say, $1,000, and they sign over the property, and we will then list it with a local agent and sell it. And either one generates revenue. And what the preferred option is really what the homeowner wants, not what we want, because you want to give them what they want. If you don't, and you end up adversarial, then you end up in court, and that can often drag returns because of the extra time and cost that's involved. We do end up, but that said, we often end up modifying maybe a third of the homeowners, doing deeds in lieu on maybe a third, and then there's a third that either we can't come to terms with, or they have some second or mortgage that we have that is unagreeable, or there's a divorce and one party, they both can't agree, so we end up in foreclosure on roughly a third. But as a servicer, we can control that asset disposition process. We can also generate scalable fee income, not just from us, but from other funds and other clients. the demand is consistent. Up market, there's always servicing demand. Down market, in our case, is going to be more servicing demand. Again, as I mentioned, we're on Monday. It was supposed to be this past Monday, but there were a couple of last minute hiccups. I shouldn't say they were actually some minor tech issues. So we've had to push the launch until this upcoming Monday, and we're transitioning all of the loans that we currently service into the new Black Knight technology. And this is used by the biggest services in the country. So really, and technology wise, we'll be on par, and that makes us very attractive to some potential servicing clients. In doing so, as we scale the servicer, we can positively impact more and more families. And one thing of note is that in the last, at the end of last year, we were designated as a minority-owned business. The advantage to that is doesn't mean a lot to some, but to some it does mean a lot. And these are big banks. Oftentimes, they set aside a portion of their business to award to minority businesses, and as a servicer and doing some servicing related functions, the fact that we're minority owned should be helpful in getting those contracts. I'll give you an example. Currently, there are a number of banks are just overwhelmed with requests for forbearances on their mortgages, and so we anticipate that we'll be able to get some of that overflow business in order to assist them. And the fact that we're minority owned should be helpful. Some of them also subservice. They get a lot of distressed mortgages. Hey, we need to outsource this. And so we're hoping to get some of that business, and we're actively pursuing that, as well as some government contracts. You would never think, or it's not necessarily something you first think about, that a government would need a servicer, but think about this. We did meet with FDIC. FDIC does award contracts to minority-owned businesses, and when they take over a bank, lots of times there's loans on there that need to be serviced for some period before they sell them, and they do award those contracts. So we are trying to get those types of contracts. And oddly, the FDIC, when we met them, which was at the beginning of March, they had not taken over a bank, and I forget the number, but it was 2 or 3 years. It had been a long time, and last either early April or late March was the first bank failure in several years. And we expect, I think there'll be many more in the upcoming months and next couple of years.
I agree.
And so more, it's unfortunate it's happening, but it creates, for us, it does create an opportunity. Challenges, this process has taken much longer than expected. We did get our California license. The 2 longest ones were California and New York. Naturally. We did get our California, yes, of course. And so we did get California about 6 weeks ago, which was very helpful. And now we're just down in New York, and we expect that to happen very shortly. And the other part is it's a startup. Essentially we've, in AHP servicing, that money has been used to do 2 things. One is to buy mortgages, and one has been to build the servicer. And there's certainly the costs. There's a lot of costs up front, which we've been able to cover. And now, we're hoping on the servicing operation, and I'll get to this in a minute, that we will start seeing that everyone will be rewarded for that shortly. But let me talk about some challenges just in terms of the country. This is from Black Knight, which is our technology provider, and they shared this with their clients, and it's pretty extraordinary information. It was very helpful to us, and we've used it as a reference. And they put this out a few weeks ago, and they were saying, well, what they were trying to determine was, what is the impact of the different unemployment rates on mortgage performance? And they said, well, what if it hits 10%, 15, 20, or 30%? And they didn't just come up with those random numbers. Goldman Sachs said, hey, we think it'll hit 15. The Treasury Secretary said, hey, it might hit 20. And then the St. Louis branch of the Federal Reserve Bank said it could hit 30. So what does that do? And for reference, as of last week, it's at 18. So it's already, all but one of these projections, all but 2 of these projections is already exceeded. And I think they publish job losses every Thursday morning. So I think it's highly likely that tomorrow will exceed 20%. And then the question is, are we going to hit 30%? And what's interesting about this data is if it hits 30%, if unemployment hits 30%, which I think we're on target to do, it may not hit quite that high, but if it did, then the 10 million homeowners would be past due on their mortgages, which would exceed the number during the 2008 Great Recession. So that is just an extraordinary. And what's really particularly exceptional this time is that it's happened so fast. So many of these homeowners and business owners 2 months ago were in everything was normal, and now it's just completely become a huge challenge. I mean, the unemployment rate was very, very modest. I mean, well, there it is. There were 2 million people unemployed in February of this year. So 2 months ago, 3.7%. And now we're talking about that going up. I mean, it's already gone up 5 or 6 times, and there's it's on target. It could go 8 or 9 times, and that's extraordinary. And definitely will have a big impact on people's ability to pay their mortgage.
Now, what about what would you say with people that say with Congress trying to pass different laws? I mean, obviously they're throwing out stimulus money or whatever they can. Well, they call it stimulus money, right? That anything to throw out checks at people to help people keep employment and everything else. Even talking about backing up mortgage companies to keep people going. Like whether it's deferment or whatnot. How would that impact you as a company?
So we've gotten guidance from a lot of the state regulators, and most of it's voluntary, with a few that are mandatory, where we need to, they're asking us in many cases where we cannot foreclose on a home in today's market. Foreclosures and evictions are on hold in the vast majority of the country. There are some exceptions. For instance, if a home is vacant, in some places we can still foreclose on that. But if it's occupied, it's typically we're not completing a foreclosure. We're simply postponing it. And if somebody also for forbearances, if somebody was up to date on their mortgage and all of a sudden is unable to pay, we are offering forbearances, which basically means that they get, at this point, it's 2 months in which they don't have to pay, which is April and May, and then we're working them out to repay that over after that 60-day period. And the theory is that they will either regain employment, they will get stimulus monies or something like that, which will help them catch up on their mortgages. But there are people that are even simply get on unemployment because so many people have been laid off that in many states it's very difficult to get through on their websites or to get actually applied for unemployment. So that's been delayed. At some point that should catch up, and presumably they'll get the pay from when they were entitled, and that will enable them to start paying, hopefully. So that's that is. But we've had a lot of some of it's voluntary. Some of the states saying, hey, we encourage you not to do this, and which means you could not give someone an abatement or a forbearance. But the reality is these are the states that regulate us and the regulators. And so next time they're in here for their audit and you didn't follow the guidance, and even though it was voluntary, that's not appropriate. And the reality is our mission is to keep people in their homes. So our inclination, naturally we are trying to accommodate these requests. That all said, it is, it's different when somebody was up to date or was 60 days behind and was regularly making payments. They were always running just a little behind, and maybe they had modified their loans and they had done well since then. It's very easy to say, okay, this is a temporary situation. We have had people to request forbearance where they hadn't paid in a year, and hey, we need a forbearance. And it seems, even when things were okay, they weren't paying. And that is something, they're in foreclosure and they're wanting to, it's been a bit of a challenge to decipher or to distinguish a genuine request from somebody who really wants to keep their home and make a payment versus somebody who's simply trying to delay the process as long as possible, and coronavirus is an excuse to do so. So we're navigating that appropriately. But regardless, this is it's an extraordinary situation for the country, but it also will result in 2 things, which I think are probably on the next slide. First thing is there's a surge in demand for what we do. We are in contract with 3 large funds, which are going to bring their servicing to us. And we're in pre-contract with 4 additional large funds that will be, we expect to use AHP for their servicing. The goal is to sign up 20 funds by the end of the quarter, by the end of June. And these are existing funds. Many of them have kind of slowed down in terms of their acquisitions over the last few years, but they've been gearing up just over the last few weeks because they see that there's going to be a good, a healthy supply going forward of these mortgages that are defaulted. And there's also funds that were maybe doing fix and flip loans or other types of strategies who are now saying that market has become very difficult to continue with, and they are now moving to non-performing loans as their strategy. And so we are working with some of those funds that are just starting up, but are well capitalized in order to get their business. The other component of this is acquisition opportunities. Mm-hmm. And this, thinking back on 2008, when the chaos started to happen, late 2008, there were some sales. There were some sales, but lots of times those sales, the pricing wasn't as low as it got maybe 6 months later. And I think there's still some hope among sellers that this is a really short-term situation, and the economy may snap back in a couple months, and that's possible. And if it did, then the prices will be will not be significantly impacted. But there's also, I think, a reasonably good chance that it doesn't snap back, and that fast forward 6 months from now, and there will be a large supply of defaulted mortgages. And when there's increased supply, the pricing will drop, and that will have, then there'll be greater opportunities. So right now we are buying a few. We have a couple of closings we're trying to do next week, but they're both on the modest size of the scale. And I think the larger scale acquisitions and the more dramatic price cuts, we'll see those maybe in the fourth quarter this year. Notably, and go ahead.
Oh, I was saying that was actually going to be one of my big questions. I was imagining acquisition opportunities right now, the supply is really limited. It's very low currently, but obviously in 6, 12 months or whenever, I'm sure that can start increasing, looking more like what we saw in the last recession, right?
That's absolutely right. I mean, the reality is a lot of people made their payments in March. When they're defaulting is in April, and most lenders and servicers are offering temporary forbearance. So they're not considering that a defaulted mortgage, but the forbearances are generally 60 or 90 days. And I mean, it does create a challenge for those whose interim for income is interrupted temporarily. It'll be, and things kind of get back to normal, they get back to work, and maybe they get some stimulus money. It'd be easier for them to, okay, that was just a momentary challenge, versus others who maybe can't get their jobs back. They work in industries that maybe don't come back or don't come back strong. Then they may be challenged in a longer period. Yeah, and so this forbearance buys them some time, but in 2 or 3 months, forbearances run out, and now they're struggling. So that will still take a little while for sellers to, this deluge of loans to kind of go through the system, and people and sellers should say, hey, we need to sell these because they're not coming back to current. One notable thing, and this may change, I'll tell you a little bit of the history of AHP's purchasing. When we first started purchasing a decade ago, we were able to buy mortgages of all sizes in all types of neighborhoods at big discounts. And so we would buy a mortgage secured by a $300,000 home and a mortgage secured by a $30,000 home, and they were all attractively priced. As the economy rebounded, the pricing became less attractive on the higher value homes, and where we could still earn a solid return was on the lower homes in low to moderate income neighborhoods, which is where we can have the greatest social impact anyway. So that's what we focused on for the last several years. And I mentioned that for a couple of reasons. One is those homes appreciated the least. So, high-end homes and across the country over the last several years have increased in value significantly, but the segment of the market that didn't increase were homes with values of $50,000 and less, where it was generally stagnant, and in some cases even continue to drop a bit because there's a limited financing, or has been limited financing available in those neighborhoods. So we focused on those, and the reason I mention it is the majority of our portfolio currently is homes in that price range. Average value of the home securing our mortgages right now is in the $40,000 range, $40,000 to $50,000 range, and those did appreciate the least, but also are likely to depreciate the least. So to think about it, we will have if somebody, actually I think it's on the next slide, let me see if it is. No, it's not. So to give you an example, of what we buy. So we buy a home that has a balance. If we buy a mortgage, the balance is $100,000, and the value of that home has dropped to $50,000. Then we would buy that mortgage for maybe 20 or 25,000. In doing so, we will we have a significant amount of flexibility in terms of what kind of solution we offer the homeowner. But now this hits, and now the value of that home may drop, but let's say it drops 10% or 20%, 50 to 45 or 40. We're still well secured, and so I think we're significantly less impacted than value-wise than a lot of other funds. I mean, I'll give you a couple of if you had bought a home. And I'll go last go round because we haven't seen this happen yet, and it may not, but there's a decent chance that it will. But if you, in 2007, you bought a home, someone bought a home for $300,000 in California, a couple of years later, that had gone down in many cases to $200,000 or sometimes even a little bit less. And so that, there was significant depreciation. And then those homes in California, they went right back up in many cases to 300. But we stayed in these, the last few years, in these lower value homes, and I think that will, in terms of the value of our existing portfolio, I think it will fare well through this through these challenges that we're having now.
Great. Now, obviously, I want to put a disclaimer here just for those, because I know a lot of people will join us later and whatnot. But obviously, the disclaimer is we're not giving investment advice. We're not saying you should go and invest in AHP. This is purely informational for you to learn more about American Homeowner Preservation. George, I know there's other questions that are coming through right now, and for those of you that can see this, you can see there's a chat box. If you've got questions for George, go ahead and start asking those currently. So George, I know with right here, I mean, like, what is it the best way for people to learn more about you guys? And
sure, I'll go one more screen. So you can go to our website. It's ahpservicing.com. I also provided the email and phone number if you want information. But online, you can do the whole process online if you want to invest. You can go online. You can create an account and create an investment in a handful of minutes. It's a very streamlined process. Yeah, over the years, we've gotten faster and faster. But if you need help or you have questions, take a look at the website and or phone or email us, and we'll do our best to answer whatever questions you have.
You can take IRA money, of course, rollovers, things like that.
Absolutely. We've IRA money, 401k money, individuals, entities, companies, whatever the type of entity. In almost all cases, we can accommodate the investment.
Yeah, and as you mentioned, like the returns currently, it's 10% in the fund, paid out monthly, broken up monthly, correct?
Correct.
So that's pretty simple math. Can people accumulate, or does it have to always be simple interest?
Sure. So it can, at this point in time, you can reinvest your dividends if you choose. And when you do the investment, you will have the option of getting it, receiving the cash distribution each month or reinvesting. But that's only available through November. And that is because the SEC allows us 2 years to raise money. And then after that, we can no longer raise money, including can no longer accept reinvestment. So if you choose reinvestment, that will happen through November, and then after November, you would, regardless of what you choose, you'll start getting a cash distribution.
Gotcha. Okay. All right. So, well, one question I had from a client who already has money with you guys, had the money in there for several years, like I have. One of the questions they said is, "Hey, I noticed there was a drop in the last month's dividend, right?" Naturally, for anybody who's investing, I know there's several people on this list I recognize that are investing in AHP right now. People are like, "Okay, is that the signs of things to come, or was that one of those fluke things?" What would be your response to that?
Sure. So actually, no, that's on an annual basis, for most investors, we need to withhold their Illinois income tax, Illinois state income tax. So that happens every April, more or less. I will tell you that it has been a little bit of although we sent an email a couple years ago to all our 2015 investors to let them know about this, and they have a choice, because if they're an Illinois resident, they don't have a choice. They're just there's no withholding if you live in Illinois. But if you live anywhere else and you're an individual, we need to withhold. If you're a company or you're an IRA, you can put in a form, and we give a link. We provide a link where you can complete that form. And if you do so, then we don't withhold and the money comes to you. And so if anybody got, the money was withheld, and for whatever reason, they feel that they are going to take care of their own Illinois tax, let's say they file taxes in Illinois, then you can let us know, and you can complete the form. And if that money was already withheld, it'll be paid out to you. But if you're an individual and you live anywhere except for Illinois, we have to withhold. And
Gotcha.
that's for AHP servicing. I think this was the first year we did it. So they all received an email, but I think some of the older investors hadn't received an email like this in 2 years. So I apologize. We should have probably sent an email saying, hey, heads up
Reminder.
for this. A reminder, especially as it happened like concurrently with all the challenges with COVID. I think so I apologize for that lapse in communication.
And another one asked about the K-1 forms, like the tax forms coming out this year. Are those coming out, I'm assuming?
Yeah, they're all done. And I know all the 2015 A+ have been uploaded to the site, and AHP servicing, I think we have 80% upload, if not 100% uploaded to the site. And I was assured it would be done by today. So there were delays on that, but those are done. And so
Perfect.
if you go onto your site today and it's not there, reach out to Investor Relations, because it should be there.
Great. All right. So questions from our attendees. One of them was, do you have to be an American citizen to take advantage of this?
No, you can. If you're a resident of the U.S., then you can. If you're a citizen, obviously you can, of the U.S. Or you can use an LLC that's a U.S. LLC to invest if you're overseas, but you need an EIN or Social Security number. We can't accept somebody who lives in Europe, for instance, and wants to invest. In our first fund, we did accommodate that, but it does create we have to withhold the Treasury, or when we file taxes, we're required to withhold a significant amount. I think it's 20 or 30%. And it was also additional filing. So we decided it just wasn't worth doing it. So in the current fund, we don't accept foreign investors. But we know some people can create an LLC in the U.S. So that means they're going to pay what the IRS just wants to see if you're going to pay taxes. So you create an LLC in the U.S., you get an EIN number from the U.S. government, and then you are going to be filing taxes. So and you have a U.S. bank account, then it's very easy. But barring that, it's tough for foreigners.
Yeah, that makes sense. That's great. All right, another attendee asked, he says, as a loan servicer, do you expect people will be able to pay all 4 monthly mortgages in a lump sum once the forbearance?
That's a really good question.
And if not, do you expect to see a surge in foreclosures, or simply houses put on the market because many homeowners have plenty of equity in their houses now?
No, so a couple of questions in there. One is, it's real. I think you're hitting on something that's very accurate. A lot of homeowners, unfortunately, who are requesting a short-term forbearance at the end of that period are going to have a tough time catching up and making those payments. I think it remains to be seen, how soon the economy restarts and how many companies get back to where they were. But there's certainly going to be families, absolutely right, they're going to have a tough time. I suspect that we'll have a tough time and we'll end up, facing foreclosure. We'll obviously be as accommodating as we can in terms of offering modifications, but people have to have income in order to accommodate that. And I think for some people, there's a question is, how fast this unemployment rate drops after this crisis is on the back end of it. And then there was a second part to the question, which is housing. Actually, repeat the last part. It was on terms of housing.
It says if you can't, if people aren't able to, be able to pay all those 4 monthly mortgages, right? It says, if not, do you expect to see a surge in foreclosures, or simply houses put on the market because many homeowners have plenty of equity in their house now?
I think it's a combination of both. One thing that is different than last time is that back in 2008, a lot of people had very, very little equity. A lot of people had refinanced or purchased with very small down payments. And in some cases, there was 100% financing available. So that made it more difficult. I mean, when things went the wrong direction, now all of a sudden they were underwater. It was more difficult for them to even justify paying, even if they could. They owe $300 on the houses, now we're $200. Now that we're better off this time. I think the country is, in terms of more people have equity. But there were still a lot of government loans, FHA loans, done with 3% financing, 3% down. And I think we'll see some of those borrowers getting into trouble, and even if they want to sell their homes, it's going to turn into a short sale or something like that. So I think there will be, in all likelihood, some challenges in the housing market, and what people are paying today is, there'll probably be some percentage reduction in, if you buy a house today versus, or you bought a house, let's say 60 days ago, and you buy a house a year from now, what's the value difference? It's, in all likelihood, there'll be some difference. And whether it's 10% or 20% or 25%, I don't think anybody knows that. But, it only makes sense when there's going to be families, homeowners who are unable to afford their mortgages. There will be increased foreclosures. And again, increased supply will drop prices.
Yeah, great. Yeah, I could definitely see that. All right, so Jerry Gosnell, he asks, thank you for the meeting, extremely helpful. He says, what is your succession plan? Because we wouldn't want anything ever to happen to you, but we are investors.
That's a great question, actually, and I've been asked it before. So we have I have a life insurance policy. Well, this is like anticipating the worst. So I do have a life insurance policy, which is in favor of AHP servicing to the extent I pass. There is a life insurance policy that would pay out. I forget the number, but it's several hundred. I think it's 700,000 or something like that, and that would allow the company enough time and enough money to cover the period until they replace me. But that's looking at the extreme. The reality is, or more tangibly, we built up in my mind, an awesome management team. We really, over the last few years, this company does not run. I'll tell you, early days of AHP, it ran very much with me calling the shots on everything. Right now, that's no longer the case. We do have a management team, and to the extent I had to step away for any reason, then I think the company could operate successfully without me. And that's the goal. I want to be a key component of the team, but I can't be the only component. I mean, we really want to make this a large enterprise and a substantial company, and there's no way that it needs to transition. And it's been tough. I mean, it's been tough to transition from kind of an entrepreneur who's hands-on with everything to a company which has layers of management. But that's what we're in process of doing. And I'll tell you, again, it's not a natural progression for an entrepreneur.
You're right. Yeah, that's true. Yeah, I know. I get asked that question often. People say, okay, you're the mastermind. What happens if you're gone? It's like, don't worry, I'm taking care of that. I was thinking of that when I was 35 years old. That was 8 years ago. So I'm right there with you.
Good.
So, all right. So next question from William. And by the way, for those of you, again, questions, just go ahead and type them in the chats. So William has two questions here. I'll start with the first one. He asked, if you were to make a request to redeem your money and it takes 60 days to do so, do you still earn interest during those 60 days?
Yes, absolutely. You'll earn interest on the day it's paid out. So yes.
It just gets kind of prorated based on
exactly prorated until the day you get paid off. So it's not based on the day you request; it's based on the day you actually receive the money. Just like if you were investor day, today being the 22nd of the month, in the next month's distribution, you get paid just for those 8 days of April.
Yeah. So if I were to use an example, say that they're 11 months in, right, and so they're almost the 12-month mark, but not quite. Naturally, instead of getting 10%, they're going to earn 9%. You would still pay, the month that gets requested, that 11th month. You just probably wouldn't pay the 12th month because that would be, you already got paid 9%, correct? So if you got paid up to that 9, that's where you get to. Correct?
Yeah, we'll cut off the date that they actually get paid off. So if they requested in month 11, then and it was paid off on the 20th of that month, so 11 months plus 20 days, it actually reduces from 10 to 8. But they would be reduced they'd be paid for those full 20 days at 8. But if it took, 33 days, so it ended up being 12 months and 3 days, then they would get it'll go from 10 to 9.
Okay, great. His second question was how much cash reserves does AHP have in case the economy doesn't restart and a surge of foreclosures happen?
Sure. So we have. So I'll tell you how much we have right now, which is a couple $1 million. That is a little uncomfortable. I don't like to have that much money. We do at this moment because we've, but that's fluid. A month ago, we probably had or even a few weeks ago, we probably had a couple $100,000. So it's fluid. When we have that amount of money, we're paying investors on it. So I need to get it deployed as promptly as possible. So on average, we probably have about 200,000.
Turn it down. Yeah. Still, I mean, I agree with him. Like cash reserves, I think is essential, especially if there's any, well, for whether it be for opportunities or for something worse, right? Some
Yeah,
bad
absolutely.
worst case scenario. So yeah, great. BT, he's asking a question here. It says, if I'm considering opening an account as an investor with the current economic conditions, will the current economic conditions affect the current 10% return to investors? And if so, how much and when would you expect it?
We would. It's a good question. Right now, we don't anticipate it. We think what our buys can generally earn greater than 10%. The real question is how much, how much greater, and that's the question. Whether it's a few years ago, we'd hit 30s and 40s. That was on the tail end of the kind of massive supply. Right now, it's been much more modest, and so I think. I would think right now our goal is, or not think, our goal right now is to earn in the mid to high teens. So if we're hitting 15 to 20% and paying out investors 10, that would be something that we'd be happy with. And I think as we grow and scale, those types of numbers become, that's probably what we're gonna have to custom to. I think the days of 30 and 40 are probably in the past, even with the upcoming
Opportunities.
Even with opportunities, just because when you're really small, it's easier to increase the returns. Whereas as you scale, there's just more cost, more all those things I mentioned about layers of management, and we become more like a real business that's trying to earn 15 to 20% and should be very happy with it, just because it's 15 to 20% over a larger volume of dollars.
Yeah, great. Another question from Cody. He says, if the fund is already close to new investors and you request a redemption, how will a new investor buy your portion or shares?
Sure. So we can't. So if we, so we're talking about, there's a current fund is open to AHP servicing, but the prior fund is closed to new investors, which is 2015 A plus. So we would buy, either we would buy those, AHP ourselves would buy them. We either redeem them, or AHP servicing, somebody's going to buy those, or us, and we can do that and buy that.
Right. Great.
So it's yeah. But if you invest today in if you invest today in AHP servicing, you request a redemption in AHP servicing, we could simply sell that to another investor. Your interest, you invest $10,000, and 6 days later you need it back. We can either redeem it, or we can have another investor buy it. And the reason we'd have another investor buy it is because we're capped at how much we can raise in the fund. And so once we redeem it, then that's used up that cap. If it's sold to another investor, then the money stays outstanding. Right. So we're capped, and we're nowhere near the cap right now, but we're hoping, we're not hoping, but we're anticipating, with the growth over the next several months, we may get close to the cap. So when possible, we'll try to sell it.
I can see that. Oh, quick question. I had really going back to a previous question. So I know you have an SEC filing because you guys are licensed with SEC. Your portfolio usually does well over the 10% from what I've seen year to year.
It's correct. Historically, it has. The last couple of years we transitioned and it has not, but we kind of used the prior years when we were hitting 30 and 40 and used some of that money to now, instead of, so when we earned, for instance, in I think 2017, we earned 40%. I think we had about $1.5 million in profits. So we used that money to pay to distribute to investors as the returns reduce. In AHP servicing, what we've done is the company brings in hundreds of thousands of dollars a month in revenue, but part of the money that we raise is to cover losses. So our gains, we pay investors. The losses are covered by new investment money that comes in, with the anticipation that the servicing operation should become profitable in the next, probably July of this year is our projection right now.
Okay, great. Tim asks, if you have a month that pays a lower percentage than the usual because of the pandemic crisis or low on cash for any other reasons, is the deficit made up the following month? For example, I'm scrolling down here. For example, let's see. I'm trying to make sure I get the numbers, but jump down a little bit more. Okay, so for example, if you're using the receiving 1,000 per month, but during the next 3 months you only receive 500, will the extra 500 a month be made up in future months when the company is doing great again?
Absolutely. So this is contemplated in our documents, in our offering statement. And exactly what was described, or what the question suggested, to the extent a distribution is short in any month, then the next month that there's excess cash, it would be made up. So
Right.
if you were due $1,000 and you received 500, then and that went on for 3 months, your deficit is $1,500. The next time that the company had money available, we would we'd pay the all or part of that $1,500 until it was fully caught up.
Okay. And that actually ties in with another question down below here from William, where he says, those in the private funds that are, getting like 12%, for example, and the economy goes down, when the decision to decrease interest rate, will it affect everyone, new investors as well as old investors, or just the new investors to decrease the interest rate?
No, it would probably affect, for each fund, we do the same for everybody. So it would not be like, oh, this investor is going to get a reduced return, but this isn't, or it would be across the board.
Gotcha. All right.
I mean, that's only fair, and that's the goal is to treat every investor the same, regardless of whether they put in 100,000 or $100. They would always be treated the same in all respects.
So is it possible that a fund could start paying less than whatever the contractual has been?
It could. It hasn't happened yet, but it could. And if it did, we'd notify the investors, and the goal would be, right now, it's we're very bullish on even the short term, but the next few months could be tight. And if it were to go in the deficit for a moment, we would we'd make it up as soon as possible. I don't anticipate that, but I can't, I wouldn't have anticipated at all what's been going on the last 6 weeks. So so far we've done okay, but let's see where things go.
Yep. Another question. He says, we noticed on our 2019 K1, a majority of the dividend received is categorized as distribution. Last year, the dividends were categorized as guaranteed payments. We were wondering why the change. Just wondering what they would do on the tax return on our end.
Yeah, actually, the guaranteed payments, they could have been classified either way, but the guaranteed payments did trigger for some investors the requirement of self-employment tax, and some investors expressed concern over that. So we went to our auditor and tax preparer and said, how do we make sure that how do we classify it so it has the most positive impact for investors? And so that's the reason for the change.
Good to know. Yeah. Craig asks, what are the key risk factors new investors need to be aware of?
So we buy defaulted debt. So it's already defaulted. It's, a lot of times the risk is of default, and here it's already defaulted. So the risk of default has already comes with what we buy. However, we are buying these at big discounts, so that I think balances out the risk. So the risks are, I guess the market, could go down catastrophically. And, using that example I used a little bit earlier, where someone owes 100, home's worth 50, and it is, we buy it for 20 or 25. Let's say that home were to drop to like 30, 25, 20, that would be, and that happened on a broad scale, that would be challenging. And that would be, so yes, that's a big risk. A catastrophic decline in prices in housing would be challenging for everybody. I think we're severe. That's mitigated significantly by the fact that we buy these primarily mortgages of low value, secured by lower value homes. But that's a big risk. In our current fund, we're also a servicer. So any investor is investing in both the mortgages that we buy and in the servicing operation. So I think that's a mitigant to the extent there's even to the extent what we're having now, which I won't call catastrophic, but is still massively impactful. It is already increasing demand for our services as a servicer. And so I think if it goes down that far, then there's going to be just a massive defaults by homeowners across the country. And that would, so whatever we were to lose on that, whatever, and it doesn't go to zero. It's simply like, the house was, we were in it for 25 and now it's worth 15 or 20. That would have an impact, but it would be probably in all likelihood more than offset by increased revenue and profits on the servicing operation.
Right. Great. Okay, so we had another question here. This is from Howard, who's asking about the reinvesting, right? Like reinvesting the 10%. He wanted some clarification on that. He said, if someone invested next month, it was my understanding that the reinvestment may occur for the first 24 months of that investment. Are you saying that no reinvestment of the dividend can occur starting in November 2020?
That's correct. So it's up to 24 months. I'm sorry that was unclear. So it's the first 24 months of the fund, which will go from November of 2018 to November of 2020. As with each month that comes closer to November 2020, it's, if you invested today, you could reinvest for maybe about 6 months. And then it would have to go to, we have to distribute the money each month.
Gotcha. Good to know.
The offset to that, our workaround, hopefully, is the next time we have a fund, is that we'll make it so that the dividends or the distributions from AHP Services could be reinvested in a new fund. We haven't completely mastered how to do that technology-wise, but if we could get that done by November, we would like to do that. If we would simply offer that to investors as an option instead of getting the money back on a monthly basis.
Right. Okay, so final 2 questions for you here. By the way, Jason Brown just said, thanks for the call. He asked, is the original plan of is the plan for the original funds still to return investor funds within 5 years? So is it still a 5-year note?
Absolutely, yes.
Okay, great. All right, so my last 2 questions here. First and foremost, one, what scares you the most right now about the investing going on for you? Like, what's the biggest challenge in your mind, or the thing that creates the most fear for you personally?
And I got to preface that question by saying I got about 2 minutes because I have to have a call I got to get to. But we have, what scares me the most, I feel pretty good about where we were a few weeks ago. It was, we had challenges with our productivity, work from home, moving, and the orders. We actually went to 95% work from home the first week of this, and we had to, and productivity to drop. And we needed to bring some people back into the office, and we're an essential business. And we got a letter from one of our regulators from the Department of the Treasury, which said, we furnish this to any government agencies that question whether you're an essential business. So we furnished to the city of Chicago and the state of Illinois. And, but then it wasn't, we still felt that we needed to social distance and do other things. So now we have about 1/3 of the people coming in each day. Everyone comes in at least 2 days, and that's worked out pretty well. But that's operationally, that's been a huge challenge. I think we'll see big opportunities in this downturn. I think I'd be more nervous or more uncomfortable if, the market that we had continued to go on much longer, because that was, opportunities continue to dry up. So I feel good about where we are. I wish the best for every homeowner and every person in America right now, because I know a lot of people are going through extraordinary challenges. But that, with that, those challenges, I think AHP can play a key role for a lot of homeowners and investors in terms of making the best of this unfortunate situation.
I agree. And that kind of led to my follow-up question on that. Is the biggest opportunity you see right now, what excites you the most about what you're seeing right now?
I think we can grow. I'm really excited to grow the servicer. I think there's, we have X amount of dollars to buy a certain number of loans, but the servicer is massively scalable. And I just, we got Black Knight, we're almost done. I need this New York State license, which I should get, hopefully next couple of weeks. And then we are a very attractive servicing option for a number of large funds, and it will enable us. That's what makes, something that's repeatable and scalable. The servicer, can weather, down markets, up markets. Is always a demand, increased demand in this type of market. So that's what excites me the most.
Awesome. Well, George, I appreciate your time. Of course, everybody, you can check out ahpservicing.com, and get more questions answered there as well. So again, thank you so much for your time today.
All right, I appreciate it. Thanks, everybody.
You bet. We'll see you, everyone.
Bye. Thanks, Chris.
Bye.
See ya.